If you are trying to save your job by playing patience or scrolling Facebook to the last page possible, I have a bad news for you. You are possibly at Fed's layoffs radar. Other specialists, however, cannot have peaceful night either. What kind of economic hell is Federal Reserve preparing in the meantime? That's the question we try to answer during our new Blockrevision episode. Thank you very much for tuning in. I hope that everything goes fine with audio quality, as I have made some tweaks. So we are starting over with our new block revisions episode. But if you have any questions, remember about putting everything below the video when it's chat live. When it's chat live. All right, let's get. Okay, and let's start with economy view. What we got out there. At first, let's jump to spiral that the Fed fears the most. So we are continuing a saga of what may go wrong in Fed policy that will prompt them to change their attitude to markets. I'm taking a look at wage growth that is not letting up, pointing to stronger inflationary pressures. Just look at this. United States non-farm unit labor cost right now is showing that we are still increasing the pace and nowhere near from stopping. Right down lower, we can find how it maybe extend the view. Change in average hourly earnings, all private industries, and that's also increasing. And this monthly change is higher than the news back. The only one month that was that the growth was bigger was back in October of 21, when we were in a kind of a robust span in terms of markets expansion, where the Fed hasn't delivered any marks of possible interest rate hike. And right now we are fighting up with these inflationary gauges by increasing wages that high. That's unbelievable. So in some cases, the best single measure of core underlying inflation is to look at wages exactly. It's good that people are getting work, and people that are getting high wages. But if workers continue to demand more wages to keep up with ever higher overall costs, that's what Fed is most feared about. Central bankers see a risk that pay and prices will combine to push each other higher in what's known as a wage price spiral. That's what we need to consider when finding out that this inflation maybe will stay with us a bit longer than at first we were considering. Um, okay, what we got next? WSJ, this Wall Street Journal, has previously been an oracle. This press had an astounding foresight power when it came to Fed's following moves. This time it found that Federal Reserve will get down of acceleration of interest rate hike just in December, with getting back to this its previous path of hiking interest rates at more increased pace since February's meeting. For now, however, the dominant power pushes the market to this wager on 0.5 hike interest rate, and that's what we found on a probability rate being found in CBO's rates. Um, so we are dealing with stronger demand for labor, stronger demand in the economy, but Fed needs to take their lamps right now for expanding a liquidity greater than any other time in history, and that they have backtracked later than anyone could ever expect it. The end of the world will happen, however, when the Fed start to be forward looking and not be backwards looking when implementing policy, in my opinion. So we have still not even halfway through with dealing with inflation. It may last this heightened level may persist for 2023 and 2024 with no possible chance to get below this objective of 3% yet. So that's the one thing that we really find miserable. Right now, let's have a look at this. Is your pocket in trouble? Americans are starting to borrow in a serious way once more, doing this in an excruciating way. Interest rates charged for credit card debt, as well as the lagged effect of fiscal stimulus that right now that permeates economic structures. We are also forgetting that the lag of monetary policy having its repercussions in such consumers' attitude. Even if the Fed does start to ease as early as next summer, that easing won't have much of an economic effect until well into 2024. And investors are not discounting the implications of that policy, which operates on a lag of 6 to 12 months. And all this together is going to create a recession in 2023 if we add up those possible elements that may bring some problems. And that might be the most anticipated recession we've ever had. So have literally we have literally have caused, I mean, Fed has caused this. Is it no more China COVID jolts? That's the question. Whether if we just wonder about what may bring this market circumstances we have found out, it's previously been like a whack-a-mole game when they have tried to squeeze every single COVID case down there. But this couldn't last long. Beijing now signaling a decisive shift away from its zero tolerance approach to combating COVID infections. Economists say China desperately needs more monetary and fiscal stimulus to support the recovery into next year. Could it be a prologue for world rebounding in 2023? As we know, had a world's GDP in some extent also boils down to what is going on in China. Distortions in the Chinese factory structures only got things worse. Just recent turn of events giving it a light in tunnel for this economy pivot coming up where policymakers' pain point is being reached. It looks like China is not as silly as it seemed at first and trying to offset total control over the civilians' social moods and also economic growth. But we will see how the things go, whether they will stick to their verbal initial guidance with that in mind that they had already troubles following their own rules. So I will get you informed. That's why I invite you for subscription onto this channel. Let's get to market outlook, and for this one, I will switch to what we got. The web page, not this one, commitment of traders. Right now, I will get you to our charts, and for today, I have for you alone the most important chart. The word is looking at right now is SPX, as its trend line is irresistible. We are finding in a very, very interesting point where during next few sessions we'll find out whether we are able to get out of this channel to end up with bears for good, at least in a medium-term horizon. However, the one thing that bothers me the most is this recent bull candle, literally when its acceleration right to the boundary that is yet a resistance. That usually means we are on the way with some trouble, as that might be a fake out that is trying to push many investors to buy up right around this territory. So for now, I would rather expect that SPX will rebound and move downwards, but we need another evidence for this one to happen. That's why next 2 or 3 sessions should be the final answer to the question whether we are able to get out of this or getting back downwards to the previous support at 3300s. All right, so that's SPX right now. Let's getting back with our market outlook, and as we are through with this, let's get to crypto outlook for now. Diamond sector. So let's talk right now about one of the most egregious cases in cryptocurrency industry ever. In some cases, ever. The moves show authorities are casting a wide net as they embark on the investigations into FTX collapse. Before the collapse, there were many red flags from many corners of Sam Bankman-Fried's empire. But as long as the music was playing and party was going on, nobody was enough inquisitive to investigate the issue. A crypto industry lives in a land from time to time when the rock enormous gains when there are enormous gains, nobody dares to discover the truth underneath many projects with poor foundations. Also, some mechanism may bear some resemblance to Ponzi schemes that also are missed by those many analysts and researchers. This vicious circle repeats over and over again till tide starts ebbing. This ambiguity that is often met in the cryptocurrency space, what's going on with money staying behind the project as their financials are not public, it's becoming a salt in the eye in the cryptocurrency industry in that time like this with FTX. But on the other hand, that shadow aspect of running a business in crypto sparks emotions and hopes for stratosphere gains when everything goes fine. That also entails many amateurs to the market that are most likely to lose its all money by the fancy promises of the industry. One thing is clear: regulatory push doesn't stem from just the one crypto company, but it's a result of long-lasting, versatile problems. So we are on the somewhere at the beginning of regulations that are coming to the industry. The question is whether the industry will react with fear to the things that may come or not. The price action will tell us. So I will get you informed and get you updated in the episodes to come. Right now, let's get to some of the technical elements of cryptos. What about seasonality? So right now, a whole bunch of people are flocking to the CME to short Bitcoin. That's what backwardation means to us. People are staying away from offshore exchanges and they are looking at platforms that are going to be around with the bets expire. So, as we can find right here on the bullet points, usage of DeFi vehicles drops along with this and drops along with this an interest in crypto. Futures are becoming safest bet in the markets as after this exchanges collapse and that many vehicles that have used to work, right now are turning away and finding out more traditional um, pathway to make some bets. That's why I do find that DeFi was an experiment that brought some promise to the industry, but haven't fulfilled that, and that's the element that needs to be fixed before this bulls come over once again. That's interesting. Open interest in Bitcoin is where we were back in July of 2021. So it's still somewhat high and gives some chance to recover from here and start a bull side of a movement. But also, if we just have a look at that, we still have some room downwards. This open interest may have still a large room to slide and may tank somewhere around the levels that we've seen before this really started, somewhere at the half of the current levels. So that's the thing. That's the thing we're really finding miserable. Okay, so what we got out there next? Market mover section. That's also worth watching. And just jump to what we got out there in terms of market calendar. Okay. Yes, that's it. What we got on what we had already on Monday. On Monday we had PMIs. Yes, I've already discussed this over. It was kind of a surprise in terms of today we had exports and imports, but are awaiting for PMIs from Canada, and also we will have some important data of Australia. But we are expecting on Wednesday to have higher volatility as there are some other gauges from labor market to watch. Okay, so that's from this side. Right now, let's jump to trade idea, and uh, with this one, I would like to ponder with me this chart, not SPX as we already discussed. Natural gas. I have something for you of very interesting chart. We are after around 30% of drop in a single move on natural gas, and we are just approaching a very solid uh, support level, support area, I would say. 5.3 is the lower boundary of this support, and what we could find right here is that um, natural gas should react to this level. However, right now, if we won't have a very particular uh, pivot structure, somewhat found as a very visible hammer or engulfing pattern in some way, or at least consolidation at the bottom, uh, such as we had right here, I don't find we will rebound out of this area right now. This support should have its reaction, as it's not out of significance for the markets, but just be cautious, as everyone sees this, as it's very clear. That's why there might be a fake out to the downside, as it often happens, and then revert back higher. So for me, natural gas is the one to watch, one to set an alarm right around what I made with this dotted yellow line at 5.3, and afterwards we will find out what's the reaction down for this area. So for me, if the natural gas will get to the level of 5.3 and somewhat interesting pivot structure will build up, I would expect this one to move like this to filling up this gap that usually with high probability fills up, but this procedure every procedure should be followed with a very tight stop loss. So with this stop loss being set right around this level, risk reward ratio at 6 is still possible, but always remember about being cautious. If you are not at least I would say semi-pro trader, I would skip this one and wait for another opportunity. I will let you know next episode. So for this episode, that's it for me. Thank you very much for watching. Sorry for my voice, as I'm still recovering this ill that got to me. So thank you for watching. Tomorrow at 8:45 a.m. is time. We are back. Let me find out whether you have posed any questions. There are no. So thank you for today, and once again,